Welcome viewers. I am Dr. R. Amuda from School of Management, Sastra Deemed University. I welcome to the session Ratio Analysis. Before going to the meaning of ratio, the significance of ratio analysis in managerial decision making, the various classification of ratios, we shall now see what is the necessity of calculating the ratio analysis. Before going in depth to the various formulae regarding the ratios, now let us see the very basic necessity in any organization for the calculation of ratios. As we already seen, the very basic necessity of preparing a financial statement is to convey the basic information to all the stakeholders, namely the owners, the creditors, the investors, public, the government, consumers, employees and the like. As you know, accounting is said to be the language through which the concern is speaking to the outsiders and also the insiders about what is happening in the organization and what has happened in the organization. All financial accounting records are said to be the historical records which speaks about the information which have already carried out in the organization. Simply preparing the final accounts will not imply any information to the outsiders. We must have certain analysis and interpretation of all this information. Only then the users of the financial information can infer something from the financial statements. How to do this analysis and interpretation? When we mean analysis, it is a relationship between two figures or two numbers. When we study about the relationship or an association between two numbers and your two figures, we will have a fraction or we will have a percentage or we will have the proportions. Based on these percentages, proportions and numbers, we cannot infer anything. Before going to the in depth to the ratios significance, we must know how to interpret all these numbers. So interpretation of all these numbers, interpretation of all these propositions gives the meaning to the financial statements. So this is how the management is handling the ratio analysis as an effective tool in their hands. Now we shall see what is the meaning of ratio. It is a comparison of two or more numbers that indicates their sizes in relation to each other. See, we used to say Ram is said to be 2 times height, 2 times more than the weight of that of another person called as Mohan. So this is said to be the number of times, number of sizes. Say A is said to be 2 times bigger than B. A is said to be 2 times smaller than B. So that is said to be the sizes. So it is a comparison of 2 or more numbers that indicates their sizes to each other. And it is said to be a mathematical relationship between two items expressed in a quantitative form. Quantitative form, it is a numerical form. Arithmetically, a ratio is a comparison of the numerator with the denominator. So every ratio will have a numerator and a denominator. So the relationship between the numerator and the denominator determines the ratio. Ratio is a quantitative relationship between two amounts depicting the number of times one value contains the another. So x is equal to 2y. So x is said to be 2 times of y. So this is said to be one value contains within the another. Ratio is a relationship expressed in quantitative terms between figures which have a cause-effect relationship. So we should not calculate ratios between two numbers which is not related. So unrelated figures will not give any interpretation. Unrelated figures will not give any meaningful meaningful information to the outsiders. So we must have a cause-effect relationship. So cause is said to be, say, profit is said to be the effect. Cause is said to be the sales. So if we have an increase in sales, we have an increase in profit. So we must have some relationship between two figures or two numbers which are connected with each other in some manner or the other. Accounting ratio is a quantitative relationship between two or more items of financial statements connected with each other. So far we have seen what is the meaning of ratio. Now we shall pass on to the accounting ratios. Accounting ratios are those ratios which are calculated based on the financial statements information. Whenever we mean financial statements here, we mean the profit and loss account and the balance sheet. So the ratios are calculated from the information taken from your profit and loss account and also the balance sheet. So the relationship between the sales and your net profit, the sales and your gross profit, the sales and your total assets, the sales and your fixed assets. So these are all said to be the associated relationships between the figures. Financial statements contain historical and static information. As we say it is historical, it has a past information. Static information, we cannot change those information hereafter. So whatever happened in the past is said to be past. So this is said to be a static information. In absolute terms means it is in exact terms. Say sales is 15 lakhs during the last year, it cannot be changed. So this is said to be the correct term. So and does not provide the relationship between two or more items in the statement. So this financial statement do not say about the relationship between the two figures. They say sales is 15 lakhs and profit is 2 lakhs, that's all. So it will not say the profit is said to be 2 by 15. So this will not be depicted here. For this purpose, we are going to calculate the ratios. What is the basic objective of calculating a ratio? Mainly, it is to help the users of your financial information. These users may be external users or your internal users. Internal users will be normally the employees, the managerial personnel. External users may be the customers, the government, the creditors, the banks and the other institutions which are lending credit to the organization, and any researchers who are doing their research on the financial information. This helps the users of financial information to analyze. When we say analyze, find out the relationship between two numbers. That is your analyzing skill. Interpreting women based on your analysis, based on your figures are right, based on your numbers are right, we are going to interpret. Assume that the net profit is 20% now. Say in the next year, then the net profit increases by 1%, 21%. So we can say that there is an increase in the rate of net profit. Next year also, we have 22%, another 1% is increase. So we can say that the increase in the net profit is constant. So it increases 1% every year. Suppose if the increase is in an increasing trend, say for example, first year we have 20%, next year we have 21%, third year we have 22%, then next year we have 25%. So the increase over the years is said to be increasing. First year it was increasing by 1, next year 2, next year we have 3. So this is said to be the increasing trend of your increase. So this can be interpreted, this can be inferred from your analysis and express the implications of relationships between two or more items. Now we are going to express how this increase has been made. So we are going to find out the reasons for the increase. Suppose if we have any decrease, again we are going to find out the causes for the decrease also. Analysis involves a scientific way of examining the facts. So we say it is a scientific way. Why we are saying it as scientific way? All the ratios are calculated in a very systematic way. We are going to determine what is the basic relationship between two figures. So nonsense relationships are not calculated. Only sensible relations are calculated. That's why it is said scientific way. Whatever the analysis that has been made through the ratios will definitely help the stakeholders to take the decisions regarding the business policies. Interpretation is the act of explaining, reframing and inferring from the analysis made. So we are going to explain it. Suppose when you want to reframe your own policies or revisit your own figures, then we are going to have a refining of your information and inferring from the analysis made. It is the inference made, and based on this inference, decisions will be made. So only based on your inferences, the management is going to take the decisions. Now we shall see how these ratios are expressed. So these ratios are expressed in three main modes. First one is the proportion. Proportion women 2:1. 2A is equal to 3 C. So it is a proportion. This is 2 times, that is 3 times. So 2:1. when current asset is 2, when we have current liability is 1 part. So this is explained in parts. So amount of 2 items expressed in a common denominator, 2:1. Then next one is in terms of rates or times or coefficient. So this quotient obtained by dividing one item by the another is taken as the unit of expression, that is 2 times. 2 times means say stock turnover ratio. Stock turnover ratio is 2 times. 2 times means in a year the stock is turned over into cash for 2 times. That is said to be in rate or your times. Then next is in percentages. This percentage woman, the quotient obtained by dividing one item by another is multiplied by 100 to show the relationship in terms of percentage. That is 25% or 30% or 50%. Say when net profit ratio is 20%, we mean that for every 100 rupees sales, 20 rupees is net profit. That is your percentage. So this is the way in which the ratios are expressed. Next is the steps in your ratio analysis, how to calculate the ratios. First one is selection of relevant information. So relevant information from the financial statements should be selected and calculate appropriate ratios. So we are going to calculate appropriate ratios from the relevant information. What is so-called relevant information? So we are going to assess your own financial information. When you are going to assessing it, now we have to access the information which is directly related with your decision making. Say for example, we are going to decide about the sales budget. Now when we are going to prepare your sales budget, I want to know what is the past record of my sales. So when I am going to see about my sales, I am going to see about what is the trend in your sales over the years. This is the relevant information. Say I want to decide about my dividend ratio. So what is the actual payout ratio over the years? So this is the way in which we are going to pick out your relevant information. Whatever that is really related with your own decision making is called as relevant information. So based on this relevant information, we are going to calculate what are the appropriate ratios to be calculated. Now next is comparison of your calculated ratios. Now whenever the ratios are calculated, it should not be kept within your organization. It should be compared over the years within the organization or compared with your industry average. Now, let's say we come to the gross profit ratio and a net profit ratio. When your net profit ratio is 15% or 20%, now I could not satisfy with 20% of my net profit. I am going to compare my net profit ratio with the industry average. Suppose if the industry average is 25%, now that is said to be the benchmark. So this net profit ratio of my concern is lesser than my industry average. In this case, I must decide how to improve my net profit ratio. This is the way in which we are going to compare our calculated ratios with the industry average or with the similar firms or over the past years. So when we are going to see about your past years, I can very well know whether my net profit has increased or not. And I am going to compare with my similar competitive firms and I am going to see whether I am able to meet my competition. And I am going to compare with the industry average and I am going to see whether I am up to the industry benchmark or not. Next is interpretation and reporting. So this interpretation is very important. As we already said, analysis is not enough. We must interpret and we must draw inferences and we must write a report and submit it to the top management. This report should recommend a specific action for implementation and decision making situations. We shall see what are the merits of calculating these ratios, because ratios plays a very important role in any business organization to interpret your financial statements. First, we shall see the advantages of ratio analysis. Forecasting. Forecasting women, we are going to foresee your future, plan for your future. Ratios reveal the trends in your cost, sales, profits and other interrelated facts which will be helpful in forecasting your future events. So based on my past ratios, I can even predict what should be my ratio in the future. So if my stock turnover ratio is 2 times, I can increase my stock turnover ratio to 3 times in the current year. And what is my debtors turnover ratio? What is my creditors turnover ratio? How to improve these ratios? How to improve my own liquidity? How to improve my solvency? So this can be made this forecasting can be made with your past ratios. Next is managerial control. This ratio analysis is said to be an efficient and an effective managerial technique in the hands of the management to decide about many situations, to decide about your own sales, to decide about your working capital position, liquidity position, solvency position, etc. Next is it facilitates communication. So this communication function of management is very important. These ratios convey information relating to the present and future quickly, very forcefully and also very clearly. So in a very absolute terms, all the information are communicated to the people who are really using the financial information. Next is measuring efficiency. These ratios measures the operational efficiency by comparing the present ratios with those of past working and also with those of other firms in the industry. So inter-firm comparison and intra-firm comparison gives the management a clear-cut vision of preparing the financial statements. Then facilitating investment decisions. These ratios are helpful in computing return on investment. This ROI is very important. ROI is the return that is expected, the profit that is expected on the investment, that is your shareholders' funds. Then this helps the management in exercising effective decisions regarding the profitable avenues of your investment. Then it is useful in measuring financial solvency. Solvency here, women, all your assets must be more than the liabilities, that is your solvent position. So all your solvent position is decided using your ratios. This liquidity position is also decided based on your solvency position. Any company may be solvent, but it may be illiquid. What is liquidity? Ability of the firm to meet its commitments, to meet its requirements, to meet its obligations, that is in a very short period of time. That is your liquidity position. A company may be solvent enough, but it may be illiquid. So this liquidity position determines your working capital position of your organization. So this is said to be the economic barometer in any organization. So this liquidity position is decided based on your ratios. So this proportion of borrowed funds to your total resources. What is my total borrowings? What is my total resources that is deployed in my organization, which reveals a short-term and a long-term solvency. So the solvency is divided into two different periods. One is short-term solvency, another one is long-term solvency. Short-term solvency decides about your liquidity. Then inter-firm comparisons. This inter-firm comparisons helps the management to compare its performance with the external benchmark or a standard. Next we shall see the limitations of ratio analysis. Though we have many advantages of ratio analysis, we have certain limitations which constrains the usefulness of ratio analysis, but that can be avoided. First is practical knowledge. The person whomsoever is calculating the ratios must be efficient enough in calculating the ratios. He must be an expert analyst in calculating the ratios. So he must have a good knowledge and experience about the firm and the industry. These ratios are not only the means, it is not the end. So ratios may facilitate to take the decisions, but ratios alone should not decide the any situation. Next is interrelationship. Ratios are said to be interrelated and therefore single ratio may not convey any meaning. It has to be interpreted with reference to the other related ratios to draw the meaningful conclusions. So single ratio should not be taken to make any decisions. Next is non-availability of standards or norms. So ratios are said to be meaningful when it is compared with your standards, but we don't have any standard norms and we don't have any benchmark that is available for the ratios. So non-availability of standards or norms is said to be a limitation. Next is accuracy of financial information. Accuracy of ratio depends on the accuracy of information derived from the financial statements. If the financial statements are not prepared as per your double entry principles, the very basic essence of preparing the ratios are maybe defeated. Then consistency in preparation of financial statement. We have the principle of consistency. You must have a consistency in preparing your financial statements, namely, following the methods of depreciation, valuation of your inventory, etc. Suppose if there is no consistency in preparing the financial statements, that will also dilute the significance of ratios. Detachment from the financial statements. Detachment from the financial statements, women, ratios are substitutes to the financial statements, but it is not alone the financial statements. They can be taken as meaningful only when it is read along with the financial statements. These ratios cannot be completely detached from the financial statements. Next is time lag. Time lag, women, when the ratios are calculated, quickly it should be sent to the management and the management should take the decisions. Suppose if there is any delay in reporting it, then the calculation of ratios will be meaningless. Then change in the price level. When there is a change in the price level, then the ratio analysis becomes redundant during the periods whenever we have high price fluctuations. I welcome to the session ratio analysis, the classification of various ratios. First classification is based on statements. Statements here, women, the financial statements, profit and loss account and balance sheet. First one is the balance sheet ratios. What are the balance sheet ratios? Balance sheet ratios, women, the ratios which are calculated based on balance sheet figures alone, that is balance sheet ratios. Liquid ratio. Liquid ratio, women, the relationship between the liquid assets and your liquid liabilities. All your liquid assets and liabilities are taken from balance sheet. Next is current ratio. Current ratio is the association between the current assets and your current liabilities. Again, it is taken from your balance sheet. Proprietary ratio. Proprietary ratio says how far the proprietary funds are utilized in your business organization. Debt equity ratio. It is the total debt and your total equity, the relationship between your total debt and total equity. Fixed assets ratio. This fixed assets ratio deals with your details of your fixed assets which are taken from your balance sheet again. Capital gearing. How far your capital is geared, how far the capital is utilized in your organization. Next is profit and loss account ratios. Gross profit ratio. GP ratio is taken from profit and loss account, that is GP and net sales. Then operating profit ratio. This is again operating profit here, women, earnings before interest and taxes, EBIT. This operating profit is taken from your profit and loss account and the net sales. Then operating ratio. This operating ratio, women, operating ratio is the total operating cost, that is cost of goods sold plus your operating expenses. This operating ratio is said to be EBIT. This operating ratio is said to be the operating expenses ratio. Then this is only expenses ratio. Next is net profit ratio. So all these ratios are taken from your profit and loss account. Then these are the ratios wherein we are going to take information from balance sheet and also the P&L account. ROI, return on investment. Then return on shareholders funds. All these items are taken from P&L account, net profit and your shareholders funds and your investment from the balance sheet. Return on total assets. Total assets is taken from your balance sheet. Profit is taken from the profit and loss account. Stock turnover ratio. This is your closing stock is taken from your balance sheet and your profit is taken from profit and loss account. Debtors turnover ratio, creditors turnover ratio, fixed assets turnover ratio, working capital turnover ratio. So all these ratios are to be the turnover ratios wherein the balance sheet items are taken and the profit from the profit and loss account is taken. Then earning per share. Earning per share, women, how many, what is a monetary item that is earned by the single equity share. Then classification by the users of financial information. First is by the management. Top management is said to be the first person who is going to use the financial statements for decision making. Operating ratio. Operating ratio, as we already said, it is the COGS plus your operating expenses. Then return on investment, ROI, stock turnover, debtors turnover, debt equity ratio, fixed assets turnover ratios, creditors turnover ratios, GP ratio, gross profit ratio, short term liquidity ratios, long term liquidity ratios, working capital ratios and net profit ratio. So all these turnover ratios and solvency ratios will profitability ratios will decide about your future of the organization. So this management is going to calculate what the profitability, solvency and also the turnovers based on your financial statements to take your futuristic decisions. Then the creditors of your organization, the persons who have extended credit, either it may be for goods or it may be for expenses or it may be for a long term loan, etc. The person whoever has extended their finance to the organization. Current ratio, they are very much bothered about the current ratio because current ratios tell about your working capital position, all your current assets and your current liabilities. Then solvency ratio, whether the firm is solvent or not. Then debt equity ratio, creditors turnover ratio, then fixed assets turnover ratio, assets coverage ratio, interest coverage ratio. Interest coverage ratio means how many times the interest may be covered by the net profit. Next is the shareholders, the persons who are very much interested in the investments. Return on shareholders funds, then payout ratio, capital gearing ratio, dividends cover and dividends yield. Then classification by purpose and your function. It is profitability, turnover, solvency. Solvency is divided into short term and long term. Profitability we have again ROI, net profit ratio, gross profit ratio, expenses ratios, operating profit ratios, then stock turnover ratio, that is your turnover ratios, creditors turnover, debtors turnover, working capital turnover, fixed assets turnover. Then solvency ratios we have short term, current ratio, liquid ratio, cash position ratio. This cash position ratio takes into account the actual cash in hand and your easily marketable securities alone. It is very short period liquidity. Long term ratio we mean proprietary ratio, debt equity ratio, fixed assets ratio and capital gearing ratio. Now we shall see each and every ratios in detail. First we shall see the profitability ratios. We have many profitability ratios. The first ratio is return on investment. This return on investment is said to be the overall profitability ratio, and this return on investments decides about the very basic profitability position of an organization. ROI is equal to operating profit divided by capital employed into 100. So this is expressed in terms of percentages. What is operating profit? Operating profit here we mean profit before interest and tax. That is your EBIT. Any profit that is arrived before paying off interest on long term funds and the provision for taxation. Now we shall see what is meant by capital employed. Capital employed can be taken in 4 different ways. First one is the total of assets can be taken as capital employed, total fixed assets alone, then net working capital plus fixed assets, then total long term funds employed in the business. What is your total long term funds employed in the business? The share capital. The share capital women both the equity and preference. Reserves and surplus. The reserves and surplus are said to be the accumulated reserves. Surplus women the profit that has arrived during the current year alone. Then we have long term loans. So add up all these items. Share capital and reserves and surplus is said to be shareholders funds. Long term loans is said to be the creditors security. So ownership securities plus your creditors securities minus long term business assets and your fictitious assets. These fictitious assets will not earn anything. What are all the fictitious assets here? Goodwill, patent rights, copyrights, preliminary expenses, accumulated discount on issue of shares, discount on issue of debentures, then any accumulated losses in your profit and loss account. So all these fictitious assets or should not be added with your capital employed. So normally we take the last one as your capital employed, that is share capital plus your reserves and surplus plus your long term funds minus your non-business assets. Why we are deducting non-business assessments? Any assets which are not related with your business, which is not a trading asset. Then all your fictitious assets are also not included. Then what is the significance of this ROI? This ROI is said to be more important in any organization, and this ROI decides the investments by the investors. It is used to measure the operational and managerial efficiency. Higher the ratio, the more efficient use of your capital employed. So if ROI is very high, so we can decide and we can infer that the profitability of the organization is very high. A comparison of ROI with other similar firms, with that of industry and with that of FAS ratio, will be helpful in determining how efficiently the long-term funds of your owners and creditors are being put into use. So whenever we mean capital employed, it is the ownership security and also your creditorship securities. Then return on shareholders' funds. What is the shareholders' funds? As we already said, it is the preference shareholders share capital, equity share capital, and reserves and surplus. Now, return on shareholders' funds is equal to net profit after interest and tax. Why this is taking it as net profit after interest and tax? Now, EBIT is said to be earning before interest and tax. Right? After paying off your interest on your long-term loans, inclusive of your debentures, we will get profit after interest but before paying off tax. Then we will pay the tax. We will get profit after tax. This profit after tax is said to be the amount available to the shareholders. Here we mean both equity and preference shareholders. So this is the profit. Profit after tax is said to be the profit available to the equity and preference shareholders. That's why we have taken net profit after interest and tax. So after this we are going to pay the preference dividend. After paying off the preference dividend, whatever the amount that is available will be made to the equity shareholders. Now as we are calculating return on shareholders' funds, now we are taking PAT as the amount available to the equity and also the preference shareholders. Now divided by shareholders' funds. Here whenever we mean shareholders, again I stress on the point, it is the preference and also the equity. Preference and equity shareholders' funds. This ratio determines the profitability from the shareholders' point of view. So this is useful for the shareholders alone. The term shareholder includes equity share capital, preference share capital, and all your reserves and profits belonging to the shareholders. So any accumulated profits, any accumulated reserves will be given only to the shareholders. So we used to say it is the undistributed profit available for distribution to the equity shareholders. This is not distributed to the equity shareholders, but it is kept as a reserve. So when this is taken as a reserve fund in any balance sheet, that means that this amount is invested outside. When it is taken as reserve account in a balance sheet, that means that this reserve is plowed back into your own organization. That is, the organization finds profitable opportunities to invest its own reserves and surplus within the organization. Suppose if it is already a firm has matured and it has no profitable opportunities within the organization, it can go and invest it outside. In that case, it is called as reserve fund. In either case, this reserves will be distributed only to the equity shareholders by way of capitalizing the profits and issuing the bonus shares to the equity shareholders. That's why this reserves and surplus are said to be the part of your shareholders' funds. The net profit means profit after payment of interest and tax. As we already said, it is PAT and includes net operating income also. Net operating income minus your net operating non-operating expenses. So we have net operating income women, non-operating income minus your non-operating expenses. This return on equity can be calculated like this. Net profit after interest, tax, equity shareholders. net profit after interest, tax and preference dividend. As we have already mentioned, whatever the money that is paid after preference dividend will be available only to the equity shareholders, divided by equity shareholders funds alone. We should not include preference here. So net worth refers to the equity share capital. So whenever we mean net worth, it means only to the equity shareholders. Reserves plus your profits minus your accumulated losses. As we said, accumulated profits belong to the equity shareholders. Accumulated losses will also be adjusted only with the equity shareholders. This ratio signifies the return on equity shareholders' funds. The profit considered for computing is taken after the payment of your preference dividend. Then return on total assets. Return on total assets women, net profit after tax divided by total assets. Whenever we mean total assets, the total of your fixed assets and also your current assets. So this is said to be your total assets. So we take both the fixed assets and also your current assets. Or net profit after tax plus your interest divided by total assets excluding your fictitious assets. So we should not include our fictitious assets. This ratio is calculated to measure the productivity of your total assets. How far the total assets have been deployed, how far these total assets have been utilized in a business organization to maximize your profitability. Then the term fictitious assets refers to the preliminary expenses, debit balances of your profit and loss account and similar other losses which are shown on the asset side of the balance sheet. The next ratio is gross profit ratio. Gross profit ratio women GP divided by net sales into 100. This is also expressed in terms of percentages. Gross margin or trading margin indicates the difference between the sales and your direct costs. Direct costs women, the costs which are directly entered into the production. So sales is taken here as net sales. Sales less sales returns. It explains the relationship between gross profit and sales. Higher the ratio is preferable, indicating a higher profitability. So this gross profit ratio says about the total proportion of direct cost in your sales. A higher GP ratio may be due to. Now we can see how the GP ratio can be increased. Increasing the selling price without a change in COGS. What is your cost of goods sold? All your raw materials plus your direct expenses and your direct labor. So this cost of goods sold will not change, but we have an increase in your sales. So being a cost constant, we are increasing the revenue. So in the case of increasing the revenue, GP will increase. Then decrease in COGS, having selling price as constant. Suppose in case of market conditions, if the company is not in a position to increase its selling price, so it has to control its own cost. So when it controls its cost, then with the given revenue, again GP will increase. Now we have a situation wherein the selling price can also be increased and the COGS can also be decreased. The cost can also be decreased. And again, in case of sales mix per month, the number of items that is offered by the organization for sale in a market. So when the sales mix has a higher gross margin products, that is one product may be giving a highest profit and another product may be giving a moderate profit. So in this case also GP will increase. So increase in selling price without a change in cost, decrease in cost without a change in selling price, increase in selling price with a decrease in cost, and having a higher margin products in a sales mix. So in all these situations, the GP ratio may be increasing. Now we shall see how the GP ratio may be lowered also, the just opposite situation, where we have an increase in cost, where we have a decrease in selling price, where we have increase in cost and have a decrease in selling price, and where we have a low margin products in a sales mix. So in these situations, the GP will decrease. Next ratio we shall see operating ratio. This ratio indicates the relationship between total operating expenses and the sales. What is your total operating expenses? that is your cost of sales plus your operating expenses divided by net sales. Net sales here sales minus sales returns. Again this ratio is expressed in terms of percentages. Operating expenses include COGS, administration, selling and distribution expenses. What is this administration expenses? Administration expenses the expenses which are related with administering an organization. All your office expenses, all your managerial remuneration, then your foreman's salary. So all your administration expenses are taken into account. Selling expenses the promotional expenses, advertisement expenses, all these expenses are said to be selling expenses. Distribution expenses includes warehousing expenses, warehouse keeper's salary, then the rent of your warehouse, then we have delivery van expenses. So all these expenses are distribution expenses. Never financial expenses are included. Now dividend on your shares, and interest on your debentures, all these items are not included. So we are going to take only the operating expenses. Operating expenses includes the expenses which are related with the operating of a concern. What is the operating of a concern? Buying and selling of goods. So whatever the expenses which are related with the buying and selling of goods alone will be taken into account. It indicates the operational efficiency of the concern. It shows how the management is able to control the operating cost in the organization. Lower the ratio, more is the efficiency, because this ratio includes only the cost of goods sold and your operating expenses. Only when the cost is controlled by eliminating the wastages in the organization. The wastages may be elimination of your wastages of raw materials, elimination of your idle time of your labor, controlling the other direct costs will lower your ratio. Whenever the ratio is lowered, it indicates a higher return to the shareholders. Automatically the profit will increase. When the cost is controlled, the profit will increase. When profit increases, the return on the shareholders will also increase. Next comes the operating profit ratio. As we already said, operating profit here the EBIT. It indicates the operational efficiency of the firm and the efficiency of the management in conducting the regular operations. Operating profit divided by net sales. Whenever the sales is taken here, it is sales minus sales returns. Again this is expressed in terms of percentages. Operating profit net profit plus non-operating expenses minus your non-operating income. What is this non-operating expenses? Non-operating expenses are those expenses which are not related with your regular running of the business. Again, non-operating incomes are also not related with your regular running of the business. Say in case of your preliminary expenses written off, goodwill written off, then any patents that is written off, any amount, any expenses that are written off will not be taken over here. Again, the income on your investments that are made outside is said to be a non-operating income, which is not related with your regular operation of the business. So this operating profit net profit plus your non-operating expenses minus your non-operating incomes. I'll tell you why this non-operating expenses is added here. See, when you prepare your profit and loss account, all these non-operating expenses are shown on the debit side of your profit and loss account. So these non-operating expenses have already been shown on the debit side and it has decreased the profit. Now we are not going to take into account the non-operating expenses. As it is already deducted, now we are adding it back. Again, this non-operating incomes are said to be deducted here. See, on the credit side of every profit and loss account, non-operating incomes are shown. So this is added with your profit. This non-operating incomes are not related with your business. So as it is already added, now we are deducting it. That's why it is deducted here. So net profit plus non-operating expenses minus your non-operating incomes. Now operating profit can also be taken as gross profit minus your operating expenses. Expenses ratio next. Expenses ratio is calculated mainly to know about the proportion of each and every expense in the total. Administrative expenses ratio. Administrative expenses divided by net sales. What is the proportion of administrative expenses in your net sales? If sales is 100, 2% is your administration expenses. So that is your main proportion. Then selling and distribution. Selling and distribution divided by net sales. Again, financial expenses ratio. Financial expenses divided by net sales. Similarly, these ratios can be calculated for any expense like direct material cost, direct labor cost, fixed, factory overhead, selling and distribution overhead, whatever the overhead cost, machinery cost. So whatever the cost we are going to calculate, we are going to see what is the proportion of these costs towards your sales. So this gives the management an idea of controlling the cost, suppose if there is a hike in the percentages. Next comes the net profit ratio. This net profit ratio indicates the return on your shareholders' investments. Higher the ratio, the better is the operational efficiency of the firm. Net profit ratio means net profit after tax divided by net sales. So this is the profit that is taken after tax, profit after tax, PAT, divided by net sales. Net sales, we know, sales minus sales returns. Again, this is expressed in percentages. What is your net profit? Net profit plus your non-operating incomes minus your provision for tax. So provision for tax is taken as a current liability, so it has to be deducted from your net profit. So this net profit ratio gives the common idea about the profit that has arrived after meeting all your operating expenses and to know about what is the actual return on your investment. This gives a significant information to the investors for your further investments. Next comes the earnings per share. It indicates the capacity of the concern to pay dividend to the equity shareholders. This ratio is useful in determining the market value of the shares. Earnings per share woman, net profit after tax and preference dividend divided by number of equity shares outstanding. As we already said, EBIT will be taken into account minus your interest, EBIT minus your interest will give you earnings before tax. Then you are going to deduct your tax. After deducting tax, we will get profit after tax. After deducting your preference dividend, you are going to get the amount that is available for your equity shareholders. This is the way in which we are going to calculate net profit after tax and preference dividend. Take your operating profit, EBIT, earning before interest and tax, minus your interest on long-term funds, inclusive of your debentures, you will get earning before tax, pay your tax, you will get profit after tax, then pay your preference dividend, that is the amount available to the equity shareholders. So net profit after tax and preference dividend divided by number of equity shares outstanding. So how many numbers of your equity shares outstanding divided by it, you will get your earnings per share. So what one equity share is going to earn. Next is price earnings ratio. This indicates earnings per share reflected by your market price. MPS divided by EPS, market price per share divided by earnings per equity share. This is useful to the potential investors to decide whether to invest in the equity shares of the company at a particular market price or not. This EPS, earning per share, is going to influence the market price per share, MPS. So how far this EPS is accelerating your MPS? This is studied in your price earnings ratio. How far equity share is going to earn its price in the stock market. So this earning of its price in the stock market depends upon your EPS. So this price earnings ratio is said to be a useful guide to the potential investors whether to invest in the particular organization or not. Next is payout ratio. Payout ratio means the amount that is actually paid as dividend. Now assume earnings per share is said to be 15 rupees. This 15 rupees is not actually paid to the equity shareholders. Out of this 15 rupees, they are going to retain certain amount. This retained amount is called as retained ratio, and whatever that is paid is called as payout ratio. So why this amount is retained? If a company is said to be a growing concern, The amount that is retained will be used for the further development of the business. It may be an expansion or it may be for a diversification. Expansion woman going in the same line of business, going for next branch or going to open another unit, etc. Diversification woman, we are going to enter into a different line of business, entirely a different line. Say if you are in a textile industry, you are going to enter into a iron and steel industry. So this diversification or this expansion will be made only due to the corporate reserves or corporate savings. This corporate savings will be made with the retention ratio. How far you are going to retain. The higher the retaining of your profits will show more profitable opportunities within the concern. So this payout ratio is said to be the financial policy of a management in plowing back of its profits. Plowing back of its profits, women, the profits are being used within the organization itself. So dividend per equity shares divided by earning per equity share. This is your payout ratio. So what is earned is not fully paid. It is only partly paid. What is paid is called as payout ratio. Equity dividend divided by net profit after tax and preference dividend. This is another way in which to calculate your payout ratio. Next is retained earnings ratio. So this retained earnings ratio is the proportion of profits that is retained in the firm out of your current year profits. Payout ratio and retained earning ratio is added, you will get 100%. So retained earnings divided by net profit after tax and preference dividend, that is your retained earnings ratio. Then retained earnings per equity share divided by earnings per equity share into 100. So retained earnings ratio plus payout ratio will be complementary to each other. If payout ratio is 90%, retained earnings ratio is 10%. If payout ratio is 75%, retained earning ratio is 25%. So both the ratios are added, you will get 100%. Next comes the interest coverage and fixed charges cover. This ratio shows the ability of the concern to meet its fixed interest obligations and its ability to raise additional funds in future. Now, this interest charges is paid before paying of your tax. So we are going to take EBIT, profit before interest and tax. How far the company is able to cover its fixed interest with its EBIT? How many times it is able to cover its fixed interest charges? Fixed interest charges, women, the interest on your long-term funds. Higher the ratio, better is the position of your long-term creditors and the company's risk is less. So if the ratio is higher, if the business is able to cover its fixed interest for 5 times, that means that it earns profit and its profit is able to pay off your interest charges 5 times. So its credibility is higher and the borrowing capacity will also increase. Dividend yield ratio. This ratio explains the relationship between the dividend and market value of your shares. DPS divided by MPS. Okay, this is useful to the potential investors to take your investment decisions. What is this dividend yield? What is the actual yield a company's share can make? So potential investors will compare the dividend per share and the market price per share. Normally, in any company, the equity dividend will be suggested by the board of directors based on your profitability of the concern. The suggested ratio will be put before your annual general meeting and the shareholders can discuss on the suggested ratios. At any point of time, the shareholders can accept the recommended ratio by the board of directors or a rate lesser than the recommended rate. This ratio, this percentage will be accepted by the shareholders and that is said to be the dividend per share. So this dividend per share is going to decide the market price per share. So we are going to say about the relationship between the DPS, EPS and your MPS. So EPS is going to decide DPS and DPS is going to decide your MPS. So this EPS, earnings per share, dividend per share and your market price per share will be the useful ratios in the hands of your potential investors to decide whether to invest in a particular industry or particular company or not. These are the profitability ratios that we have seen now. We shall see turnover ratios and your solvency ratios in the next session. Thank you.